Joining us now on the desk, Miranda van Rensburg, lead analyst at Absa Multi-Management, and still with me, Wayne McCurry. So Miranda, the reason we've got you in is because you've got a survivor's guide for savers out there, because we were talking about negative real interest rates at this point in time, and you're worried about negative real returns. Yes. So give us an indication of how one can survive in this tumultuous period.
I think we're obviously facing a period where interest rates are going to be low for longer and inflation is ticking up. So that is the dilemma, and I think one is going to have to look, investors are going to look at fund managers that can really dig deep for those opportunities across asset classes.
Okay, really dig deep, so give us an indication of how deep one should
I think you have to dig really deep this time.
Which
you can have to start looking at things like gold, for instance, but at this point it's not clear that whether you should be investing in gold, the ETF, or gold, the gold miners. There's sort of debate amongst the fund managers on that, for instance. You can look at commodities, but that's very much dependent on the rand. So you've got to take a rand view. You know, some fund managers are looking at Africa for opportunities. So I think you really have to look at those fund managers that are sort of agile and can move across asset classes to where the opportunities actually lie.
So you basically pay, though, to hold the likes of gold or some commodities.
Well, you pay to hold because they don't give you a yield. So there can only be a capital gain. Okay. But Miranda, when you look now at the current environment, and let's just say you've got a mid-range, mid-risk profile person or pension fund that you're catering to, how would you put together a portfolio for them, given all the factors you know, and given the manager? Let's even go this far as to say, given the manager environment in South Africa, because it's fairly limited in SA.
It is. You know, we survey quite a few of the fund managers, so you sort of start picking up trends in the market. And the one thing that we, for instance, picked up is that equity allocations across those balanced type of funds aren't even that low anymore. And it's not because the managers are that positive on equities, it's just that cash is expensive. So, you know, that's kind of where the balance lies.
What about inflation-linked bonds?
Yes, we've seen that. That was very popular. It still is very popular with many of the managers. The only problem is that a lot of people are now chasing inflation, or a lot of fund managers are chasing these assets because of the inflation hedge that they provide. So those aren't cheap anymore. And I think we're going to start seeing sort of a change across the market in terms of the inflation-linked bonds and how many of the managers actually hold them.
And how are you finding the market out there? Are people, do they want to invest some money, or are they running scared? What's the sort of general environment that you find?
I think everybody's very cautious. You know, it's very much about preserving your capital, and that's why it's so important to look at inflation and see
what. So it's not even about high returns right now. It's not even about high returns and risk.
No,
essentially,
it's just
all about
beating inflation and somehow just sort of, you know, keeping up with inflation. So that's what makes it quite tricky.
Is that your experience as well, Wayne?
Look, unfortunately, and I'm talking the pure retail market. Unfortunately, people are guided sometimes more by emotion than by logic.
Absolutely. And
people sell at the bottom and buy at the top. So when things are bad out there, no one wants to take risk. But you know, if you follow all the stuff that you've read about and learnt about, when times are tough out there, that's when you should take risk, because that's probably when assets are at their cheapest. And not now, I'm not talking now, but certainly directly after the collapse in 2008, 2009. And the index got to 17,000, it's now 32. You know, 17 was the time to take risk. Maybe not 32 anymore. I must agree with that. But yeah.
Miranda, what's also fascinating is a lot of the investors I speak to and asset managers are starting to increase their weighting in equities. Is that the right?
They are, and you know, I think
method
it's a
to
case
adopt
of
right now.
Just like we look at fund managers, even though you know it's a tricky market, there are still managers that can outperform. It's the same with stocks. You know, even though the market might be expensive, but there definitely still are opportunities. I think it's just kind of risky, and you need to take a long-term approach in this.
Is it about diversification right now?
Absolutely, and that's what we sort of do across, you know, and by including a number of funds in our portfolios, you can sort of get returns from various sources.
You know, during the break, we were talking about bonds and what your thoughts were on the KD's fund. Give us a sense on bonds, because right now it's still not looking perhaps too attractive to some.
Look, bonds aren't as expensive as what they were. I'm talking normal vanilla bond. But, you know, maybe if the rates go up another 0.5%, 0.75%, you could actually consider buying it. The problem for an individual investor holding cash or bonds is you pay tax on the interest. So even if you beat inflation by 4%, after tax you're going back against inflation. So over time, you know, unless you have real capital commitments and you cannot take capital risk. You actually go, you have to own some shares.
Yeah.
You just have to.
So Miranda, I also know that you are perhaps not really in favour of bonds right now because of the unattractive local yields that we've seen. Would, I mean, a carrot dangling in your face when we look at Europe, for example, or is that just far too risky?
That is, you know, once again, I think we do face a currency risk on top of everything. So even though there might be opportunities, you know, you sort of have to look at the rand and kind of where things are moving. And most fund managers seem to think that the rand is still going to weaken further. So it will be interesting to see how it kind of.
And of course, you alluded to the fact that commodities look quite attractive because we are sitting with historically low interest rates, and we know that obviously that actually perhaps helps boost commodity prices. More opportunity to be had on the rest of the African continents. What is your sense? Do you think we should have exposure?
Definitely, the impression I get is Africa gives you that diversification just because the returns are so diverse.
Different, yeah.
Very different, no correlation to the rest of the market. So I think that is a good opportunity, but there's still a lot of I wouldn't say skepticism, but sort of caution around Africa at this stage.
If you compare Africa to China, okay? I mean, China, you started to hear the word Chinese economic power in about 1993. It's only really in the last 8 years that it's come to the fore, you know, so it marked time for 10, 12 years before it did anything. And the stock market in that time period, the Chinese stock market went up and then down and then up and then down and then up and then down again, you know, so it hasn't actually been a good stock market investment over the time period. And this year, mainly because of currencies, African markets on average are down about 20% in rands. So it hasn't been a good investment this year, but it certainly does give you diversification. And hopefully we do follow the Chinese growth story and do get this 10, 12-year, you know, solid growth path. But it's still early in the day. I mean, it's still very early in the day.
Yeah.
Miranda, if new money, if I gave you some money today, what would you do with it?
I definitely think
using the survival guide that we've been alluding to the whole evening.
Obviously a bit biased, but I think the multi-managed solutions that can sort of pick on those managers that are agile and kind of look for those little opportunities that I'm talking about. You know, if you can find a solution like that.
Value investors, really.
Value, but yeah, kind of
value or theme?
What? No, I'm a value investor.
Okay.
You, Wayne?
Look, I must be honest, as I get older and older, I become less pure in my thoughts. Only as far as markets are concerned, I must stress. Okay? I just try and find an opportunity that makes sense to me that I think I can make money out of. And if I think that value...
You're taking more risk as you get older.
No, I'm trying to take less risk because the problem with saying I'm a momentum investment or a value investor, it's great when it works, but when it doesn't work, you get slaughtered. So maybe to try and diversify your style a bit as well is maybe not the worst thing.
On that very high note, thank you so very much for sharing your impure thoughts with us.
Okay,
very much appreciated. Big thank you to Miranda van Rensburg, a lead analyst at Absa Multi-Management, and of course my guest host this evening, Wayne McCurry from Momentum Asset Management.